You have been searching all this time for the holy grail of trading. The price pattern that does not fail. The price pattern that you can simply utilize to make money every time that it appears. Let me tell you something. It does not exist. The reason why you are not profitable or not as profitable as you could be is because you are chasing patterns within price action. Whether it be a breaker or a breaker plus fair value gap formation or any other price pattern. You are forgetting the most important thing. Whatever price pattern you use to enter a trade is only an entry pattern. Within any protocol, the entry pattern comes near the end of the protocol. During this lecture, I will guide you into establishing the right narrative, because you need to understand that it's the overall process that will eventually lead to consistency. Buckle up, because I have a lot to share with you. Let us first define the issue that's holding you back in your trading journey. You try to trade every price pattern, for example, breaker or fair value gap, that you see. You do not really care where the price pattern forms, you just focus on the pattern forming and you think that's a trade. This leads to you trading in the wrong direction and often getting caught in manipulation. These price patterns that you're looking for, they occur all throughout the market. They occur everywhere where you can see market data being printed. Now, how do you define which pattern is likely going to work and which pattern is likely to fail? This boils down to the solution that I will provide to you to this issue. But first we must understand that this is an issue, because if we're trying to trade, for example, a bullish breaker formation inside of a deep premium, that bullish breaker is likely not going to hold. If we try to trade a bearish fair value gap inside of a deep discount of the current range, that bearish fair value gap is likely not going to hold price to draw lower. This by itself is already a fundamental understanding that you need to achieve when it comes to trading ICT concepts. As a logical result of this issue, you lack confidence in your executions and do not achieve consistent results, because your executions are hit and miss. You can see the pattern form everywhere. Sometimes it works, sometimes it doesn't. What's the issue? The issue is that you chase patterns within price action. You're a pattern trader. The solution to this issue is narrative. Narrative is the ability to recognize what is likely going to happen within markets during the upcoming period based on sound logic. Meaning, you need to be able to rationalize and see where the market is likely going to draw towards based on a certain logic, which I will explain to you during this lecture. You need to be able to answer the following question. Why should price be repriced towards this specific price level above or below current market price? If you're unable to answer this question without any doubt, it means that there's no narrative behind your potential trade setup. A question that I would always suggest you to ask yourself is the following. Who has been making money? Have buyers been making money, or have sellers been making money? Narrative is something that we need to look at in the charts in order for you to truly grasp it. I can be out here explaining to you narrative based on theory, but then you would probably not get it still. So therefore I want to take you with me into the charts. The first example that we're going to take a look at is a bullish example of the application of narrative. What I want you to do is I want you to look at the following delivery and I want you to pause this lecture for a moment. I want you to really investigate every single price swing that took place. Why did the market form highs or lows where it did? Let us first take a look at the following. I want you to see how we formed a high right here and we sold off. The market repriced towards the downside. We took out this sell side liquidity and we eventually formed a swing low. Where was the market drawn towards then? The market was then drawn towards this high. Why was the market drawn towards that high, you might be wondering. Who has been making money during this sell-off? We saw the market deliver lower aggressively, so shorts have been making money. People that were net short and did not close their positions are holding on to profitable shorts. These shorts are profitable on paper. They place their stop losses above each high that formed during this leg lower. This is buy-side liquidity, which is engineered that we can target the moment that order flow changes from a sell program into a buy program. Now the application of narrative comes through the following. The The moment that order flow changes from a sell program to a buy program on the higher time frame, that means we will be looking for longs intraday. This means that on the lower time frames throughout the days, we will be looking for long setups, market maker buy models, because we understand that the higher time frame order flow is bullish, that we anticipate every single discount array that gets created to function as support on price. What we see is that the market grinds towards the upside before expanding aggressively, drawing towards this old high. We take out this high and the market begins consolidating. This consolidation has one function, and it is to trap people into believing that we're entering a strong resistance zone, so to say. Retail-minded traders will look at this delivery right here and think, okay, this price action is rather slow and it's messy and we're not trading above this price level here, so we can place a horizontal line there because this is resistance. The market will not trade above that level. That's what a lot of traders think. What do we see then? The market drops lower aggressively, confirming the idea of all of those retail traders. They think, okay, you see, we reached that resistance level and that's why we turned around. So now we can go short. They again go short and they chase price, meaning they go short all throughout this leg. And they think the top is in, the Nasdaq is going to free fall. This is the Nasdaq for your info. And we know that this drop lower, again, is one function. That function is to engineer buy-side liquidity above all of the highs that get formed throughout this sell-off. First of all, inside of this original consolidation here. Secondly, this high comes to mind. And that's what I want you to see. I want you to see how we engineer buy-side liquidity above these relatively equal highs, drop lower, fail to displace below the lowest BC inside this sequence of imbalances that you can see here. So that signals that order flow is still bullish. We retraced into a discount of the range being from this low to this high. We failed to displace through that discount array of that old BC. Instead, we form a low there to then attack the buy side liquidity. So what do we see? We first see that the market drops lower aggressively to then draw higher aggressively. Every single discount array that formed after this low formed began functioning as support on price. This means that on the lower time frames, market maker buy model opportunities presented itself during this leg higher. You might be wondering, why are we going over liquidity and why are we discussing liquidity inside of a lecture about narrative? What I want you to understand is the following. Narrative boils down to the following. You need to be able to look at any specific market at any given time and you need to be able to say, okay, this is where we're drawing towards because so and so. That is the logic that you need to be able to apply. You need to be able to say shorts should not happen. Let me show you an example. In this area, you would not be looking for shorts. Why would you not be looking for shorts? Because we already reached the discount of the higher time frame range and therefore we will be looking for buying opportunities. Just like we wouldn't be looking for buying opportunities up here after we took out this buy side liquidity. We would instead be looking for shorting opportunities. That means that through the use of narrative, we are able to frame which side of the marketplace we want to be on. Let's take a look at the second example. I want you to pause the recording again and I want you to look at what you see within this delivery. Please pause the lecture because you don't want to miss out on this opportunity to learn. Alright, what I want you to see is the following. I want you to see how we ran up higher after forming a low shortly after the 9:30 opening. We formed this low and we see the market draw towards the upside. Relatively equal highs get created here and the market drops lower aggressively. We form a low here and the market then begins to draw towards those relatively equal highs. Why does it begin to draw towards those relatively equal highs, you might be wondering? It's due to the following. Buy side liquidity is being engineered above these relatively equal highs, as you know, based on everything that I already shared during the first example. So what do we see? We see that this buy side liquidity, which is resting above these relatively equal highs, gets tagged, meaning this buy side liquidity gets swept and we see the signs of a high formation. Right away, your mind should be drawn to the following. You should be looking at this delivery higher since the 9:30 opening and you should be thinking to yourself, okay, I see a clear trend line that can be drawn from this low to this low and a trend line can be extended to the right. That is what every single retail-minded pattern trader will do. And therefore, from the moment that you recognize that we enter a deep premium by trading above these relatively equal highs, your mind immediately has to go, okay, I'm not going to look for buying opportunities anymore. Instead, I'm going to look for shorting opportunities. Meaning, I'm not going to buy this BC which forms here. Why not? Because the narrative is that we are going higher, we are manipulating higher to distribute lower. That's the narrative, meaning we draw towards buy side liquidity to form a high to then attack sell side liquidity. And that right there is why this BC does not hold price. And this is where pattern traders fail, because they think every single imbalance should be traded. And this right here shows it's not the case. We then see the signs of a high formation and the market begins to sell off, drawing towards the low which formed shortly after the 9:30 opening. Now, what I want you to see is that we trade below this low, form a new low, and we now begin to draw towards the upside. Why do we begin to draw towards the upside? Because who has been profitable throughout this whole sell-off? People that were short. What type of liquidity has been engineered? Buy side liquidity, which is resting above all of the highs that formed during this sell-off. Who are we going to attack when we see that we reject this low? Sellers, of course. Why? Because every single retail-minded trader looks at this sell-off as, oh, we're weak, the Nasdaq is weak, we should sell this. They try to go market short, they try to chase price, and we of course know that this is liquidity which is being engineered, which we can anticipate the market to draw towards. Why shouldn't the market continue lower? Because we saw a rejection of this sell-side liquidity which was resting below this low, and was reached at the right time, and we saw the signs of a low formation. Now, I don't want to get too in depth on the signs of a low formation or a high formation, because that's what I already taught on my public YouTube channel in the past. So if you do not understand those yet, I would highly advise you to watch those lectures which discuss those topics. But the reason why I'm mentioning this is because narrative also boils down to the fact that you should be able to know that we are likely going to draw towards buy side liquidity, because we already see the signatures of a potential low being formed, and therefore you can anticipate such a run higher to take place. Once this low was formed, we began to see premium rates on the left side of the curve get violated, and discounter rates begin to function as support on price. When this signature became present, it was clear order flow changed from a sell program into a buy program, meaning we're likely now going to draw towards buy side liquidity next. Let us take a look at the third example. I want you to pause the recording again, and I want you to take a look at this delivery. What I want you to see is how we dropped lower after leaving relatively equal highs intact up here, meaning we engineered new buy side liquidity. Why did we have to engineer new buy side liquidity? Because prior to this high formation here, the market was running up higher. So that means that everyone that was trying to buy the market was achieving profits. But at one moment, the tide has to turn. We know that we need to go lower in order to continue higher. So that means that we need to attack sell-side liquidity in order to continue higher. If we take a look at this delivery, we can see that we form a high here, and we immediately begin to see the signs of weakness towards the downside. We see these big down close candles. The market retraces and it never trades above this high. Instead, it finds resistance inside of this long wick. The market consolidates before it eventually drops lower aggressively. Why is it dropping lower aggressively? Because the fact that we did not take out this high is a sign that we're entering a strong resistance zone, so to say, according to the words of retail-minded traders. They look at this delivery here as, okay, we've entered a resistance zone, we should form a high here now, and then we need to see the signs of bearishness stepping in. They see the signs of bearishness stepping in, they see the market dropping, and they think, okay, the Nasdaq is clearly weak, I need to go short and I need to place my stop above any high that formed during this sell-off. What you see is that we take out all of the sell-side liquidity, which is resting below the falling. I want you to see how a trend line can be drawn from this low to this low. You can place a diagonal trend line here and you can extend it to the right. Sell-side liquidity is resting below that. People that utilize trend lines to determine the trend, whether we're in a bullish trend or in a bearish trend, they look at those trend lines and they think, okay, the moment that the trend line gets invalidated, my idea is invalidated, the trend is changing and therefore I need to get out. That means that they're placing their stop losses below that trend line. Notice that this lines up with those key lows, of course. This is where sell-side liquidity is resting. The market reprices lower aggressively, trading into a discount of the range from this low to this high. We trade into this wick, form a low there, and at this moment in time, the falling has to be thought of. You need to think to yourself, okay, we have just sold off aggressively, we reached the discount of the current range, and we are seeing the signs become present that we're forming a low. Who should we now attack? Should we attack more sell-side liquidity? Or should we attack old buy-side liquidity? The answer is pretty obvious. We should now draw towards buy-side liquidity resting above the previous highs. Why? Because we already took out enough sell-side liquidity in order for us to continue higher. And on the lower time frames, you will see the confirmations of a lower formation that we're looking for. From that moment on, every single retracement that's taking place on the higher time frames can be utilized for buying opportunities, because we know that Nasdaq will not roll over until we take out the buy-side liquidity resting above this high and above this high and above the highs that formed afterwards. Again, we went higher to engineer sell-side liquidity during that uptrend, so to say, during that bullish order flow. We form a high to engineer buy-side liquidity, to give the idea of weakness. We drop lower to take out sell-side liquidity and to engineer more buy-side liquidity. And we form a low to attack old buy-side liquidity and engineer new sell-side liquidity. This is how the market moves. It's based around liquidity. And you need to understand that once enough sell-side liquidity has been taken out, we should not anticipate more sell-side liquidity to be taken out, but instead see the market draw towards buy-side liquidity next. That is narrative, because then you know that on the lower time frames you should be looking for bullish patterns and ignore the bearish patterns. Let us now take a look at bearish examples. Here's the first example that I want to discuss with you. What I want you to do is I want you to again pause the recording and I want you to investigate on your own how narrative could have been applied to this delivery. Alright, I hope that you paused the recording. Let us begin. What I want you to see is that we see this expansion towards the upside taking place. During that expansion, you see multiple retracements taking place. A key retracement is this retracement into this imbalance. We form a low there and we then expand away towards the upside. Now a sequence of imbalances, bullish portfolio gaps get created. The market then begins to consolidate. This consolidation has one function, and that's to engineer buy-side liquidity resting above these relatively equal highs. The market drops lower aggressively, and this sell-off has one function, and that is to engineer buy-side liquidity. Retail-minded traders will look at this delivery lower and think to themselves, okay, we reached a strong resistance zone or level because we began consolidating here. We did not break through that level and therefore we can place a horizontal line here and we can place our stop losses above that high. The market reaches a discount BC, a discount from this low to this high, and you see that this BC, this bullish portfolio gap, is holding price, meaning the market is not displacing through it. Instead, we see a low formation taking place and the market begins to run towards the upside, meaning every single discount array that forms begins to function as support on price. Why? Because we changed from a sell program into a buy program. The signs of a low formation became present inside of this moment in time. Now, the reason why we had to change from a sell program into a buy program was because this consolidation here engineers buy-side liquidity. Think back to the underlying thought process when it comes to retail-minded traders and their perception about the marketplace. They see the market failing to draw higher, failing to expand towards the upside, and therefore this is a strong resistance level. This is the engineering of buy-side liquidity. That is the real function of this consolidation. We then manipulate towards the downside to trap even more retail-minded traders into believing that we're going to draw towards the downside, and we then form a low to distribute higher. That right there is narrative. We drop lower to go higher. What we see then is that the market expands above that original consolidation, above those relatively equal highs, and eventually a new high forms. We see a very slow sell-off, but the market begins to grind lower. Then a specific time window comes along and we see big downclose candles step in. Why does the market now draw towards sell-side liquidity? You might be wondering. During this leg higher, who has been making money? Buyers or sellers? Buyers, of course. So that means sell-side liquidity is engineered below each low that formed during this leg higher. At one point in time, the market will seek to draw towards that sell-side liquidity, meaning all of that sell-side liquidity has to be made jacked. Therefore, we first go higher to then draw lower. And this is again manipulation towards the upside followed by distribution. Now, you might be wondering, how is it possible that you just said that this leg higher was distribution and now you're saying that's also manipulation? Yes, that's exactly what I'm saying. Because when you understand market maker models, you understand that the right side of the curve within a market maker buy model can be the left side of the curve within a market maker sell model. Meaning this run higher doesn't only attack liquidity, it also engineers liquidity. And that right there is an understanding of narrative that you need to achieve. So the moment that we take out this buy side liquidity, your mind should think, okay, at one point in time, the tide will turn and I'm going to look for a shorting opportunity to attack sell side liquidity. Meaning you won't be looking at bullish breakers or bullish fair value gaps inside of this area here to look for long setups. Instead, you only look for premium raise. Let us take a look at the second example. What I want you to see is that first of all, we see the market expand towards the upside. We then see a consolidation taking place and relatively equal highs get engineered. The market drops lower, trading below the sell-side liquidity, resting below this low. The market rejects this low, meaning we do not see the market close aggressively below it. Instead, we see a purge on liquidity taking place. We have taken out sell-side liquidity, so who are we likely going to attack next? People that are in profitable shorts right now, meaning we're going to attack buy-side liquidity resting above these relatively equal highs. The market slowly grinds towards that buy-side liquidity, and we eventually see the market take out those relatively equal highs. We run above them, and at this moment in time, you can't look at these imbalances and think, I'm going to look for a retracement followed by continuation because that's what I've learned. I can trade every single fair value gap, whatever. That's the thought process some of you have. You need to understand that only the fair value gaps that form during specific time windows at specific prices function as support or resistance. In this case, you see that these imbalances get created whilst we're running above these relatively equal highs. And if you apply time to this as well, you would understand that within the weekly profile that we were in, you would not anticipate these imbalances to function as support on price. This is manipulation towards the upside. We attack buy-side liquidity, and by attacking buy-side liquidity, we are actually in the process of engineering sell-side liquidity, because below this low, below this low, below the lows that formed here, you can easily see how retail-minded traders will look at those lows and think, that's a strong low to place my stop loss. We of course know that the opposing is true and that the low will be made jacked at one point in time. But we first need to go higher in order to go lower. That right there is narrative, and therefore you would be looking for shorts in this area because we reached the deep premium, and therefore at one point in time we anticipate the market to draw towards sell-side liquidity next. Let's take a look at the third and final example of the application of narrative. Here we are on a chart where there's a lot of back and forth price action. And this might be hard for some of you to digest, but I will walk you through it. What I want you to see is the following. I want you to see how we formed a high here and we then dropped lower, meaning we attack sell-side liquidity. But by attacking sell-side liquidity, we actually engineer buy-side liquidity. Buy-side liquidity above this high or above this high, which set up the expansion towards the downside in the first place. We form a low eventually before the market begins to run higher, drawing towards this old high. We take out this old high, but we do not immediately roll over. Instead, we see the market consolidate. Why is it consolidating? It's consolidating because new buy-side liquidity is being engineered above these relatively equal highs. meaning we already took out key buys at liquidity, so people that placed their stop losses above this high were already taken out, and therefore we understand that at one point we should attack the sell side liquidity, which has been engineered during that leg higher, into that buy side liquidity pool. Why? Because we already took out buy side liquidity, so we now should attack sell side liquidity. By attacking sell side liquidity, we are engineering new buy side liquidity, meaning above these relatively equal highs, retail-minded traders will think, well, there's a strong resistance zone there, so that's where I can place a valid stop loss. They place a stop above those highs, and we know that that's engineered buy side liquidity. The market drops lower to attack sell side liquidity, to rebalance old inefficiencies, and we form a low there. The signs become present of a low formation, and the market begins to change from a sell program into a buy program. The market is now attacking buy side liquidity, old highs. So that means that we should not drop below this low, which already traded into this old volume imbalance here, into this old inversion value gap, and therefore we understand that order flow is now bullish and we should be looking for long setups. Every single discount array should function as support on price and can be utilized as a point of interest. The market eventually takes out these relatively equal highs by this leg higher, and we see something interesting occur. You see massive imbalances, fair value gaps get created. And some of you would think, look, I can trade the retracement into that fair value gap and go long. Yes, you can, but then you have not learned what I am teaching you within this lecture. We've taken out key buy side liquidity by this leg higher. And even though you see imbalances get created, you will not look at them as a potential buying opportunity. You need to look at those imbalances as the manipulation which is taking place. The imbalance shows that there's a significant price move which is being engineered. And therefore you know that that could be manipulation. Meaning we manipulate towards the upside, taking out all of that buy side liquidity resting above these relatively equal highs. We form a high, and who are we going to attack now? Sell side liquidity resting below these relatively equal lows, or even below this low. And that right there is the paradigm that you need to understand. Once this swing high is confirmed, we anticipate sell side delivery to be next, and we anticipate all the lows to be attacked. On the lower time frames, we would then be looking at market maker style models, and we would be looking at bearish breakers, bearish patterns within price action to function as resistance on price. With that, this lecture on narrative comes to an end. I hope that my application of narrative has provided you with some insights when it comes to how to properly apply narrative in your thinking behind the markets. Please stop being a pattern trader. Zoom out, meaning go to a higher time frame and determine what is likely going to happen next based on the sound logic which I just described to you. Who has been making money? Who should we attack next? When you truly understand the value of that question, you will be looking at the markets through a lens that you've never used before. I wish you all the best in your journey, and if you enjoyed this lecture, please leave a like or comment. Be safe.